Waiting for a better rate next year is really just a gamble. It's not really a good strategy. Bottom line is, don't wait for a rate miracle. It's probably not going to happen. Focus on what you can control. Mortgage rates in 2026 and 2027. What home buyers actually need to know right now. Hi, my name is Cam. I'm a local real estate agent in Collin County with Real Broker, and I make videos about the market to educate you guys on what's going on. So let's just get right into it. Rates right now in August of 2026 are about 6.77%. So where are they headed in 2027? If you've been watching mortgage rates like a hawk this year, you already know that 2026 has mixed reviews. Better than the brutal rates we saw in late 2023, but still nowhere near where a lot of buyers were hoping for. So in this video, I'm going to break down exactly where mortgage rates fall. Sorry, I got makeup on my head. Where mortgage rates stand, where they are, and two major forecasters, Fannie Mae and the Mortgage Bankers Association, and what they are predicting for 2027. But most importantly, what that means for you if you're thinking of buying a home or refinancing. Let's get right into it. Where do rates stand right now? Let's get into the numbers. As of right now, the 30-year fixed mortgage rate is sitting at 6.77%, and the 15-year fixed mortgage rate is about 5.97%. Know what you're thinking? That's still high, Cam. That's still high. And you're not wrong. You're not wrong. Tech matters here the most. These rates are actually an improvement compared to much of 2025, and they're a big step down from the 7+ rates we saw back in late 2023. So this is one of those, it's better but not quite ideal situations, right? So rates have cooled off from their peak, but they haven't really dropped into the territory a lot of buyers were hoping to see heading into 2026. The real question is, why are rates stuck here instead of continuing to fall? So why are rates stuck? Why are they the way that they are? Y'all watch Office? Why are you the way that you are? So rates are stuck here because there's really four forces at play here. And I want to break down each of them simply to you so you can understand. The first force at play is the Federal Reserve. The Fed does not directly set mortgage rates. That's a common misconception a lot of people have. But its policy decisions shape the broader interest rate environment. Right now, the Fed has paused its rate cutting cycle, and that pause is a big reason why mortgage rates are still holding higher than what we got used to during the 2010s and the COVID pandemic area. I don't want to get blocked. Okay. The second force at hand is a 10-year treasury yield. Here's the thing that most people don't realize. Mortgage rates actually track the 10-year treasury yield more closely than they track the Fed's benchmark rate. And those yields move based on investor expectations. So how confident investors are about the future economic growth and inflation. The third major factor is investor sentiment. Right now, that confidence is pretty shaky. CNN's Fear and Greed Index was reading fear as of late July 2026, not far off from extreme fear that it was. Translation: a lot of Americans aren't feeling great about the economy, and the uncertainty is filtering into borrowing costs. So that's why we see what we see. The fourth major factor is geopolitical shocks. And then there's the Iran war, which has added pressure to the rate trend. Rates have climbed more than half a percentage point, over 50 basis points since the conflict began in late February. So if we put all that together, a conscious Fed, nervous investors, high housing prices, and geopolitical instability, and you get the perfect recipe for where we are. You get the exact environment that we're in right now, where rates have improved from their worst, right? But they're still elevated. But this is what the experts are saying. This is the part that everyone really is here for. Two major institutions have weighed in on where rates go from here. So where we should see rates in 2026, going into 2027 and 2028. Fannie Mae's take is that the 30-year fixed mortgage rate will hold around 6.4% going into Q1 of 2027, which notably was also their prediction for where things will be by the end of 2026. Then in Q2 of 2027, they're forecasting a small dip to 6.3%, and they expect for that level to hold for the rest of the year. The Mortgage Bankers Association take, I'm going to call them the MBA for short because that's a handful. That's a mouthful. The MBA is a bit more conservative. As of May 2026, they forecast the 30-year rate holding at 6.5% straight through 2027, and they're actually projecting that same rate to carry into 2028 as well. What we're looking at. Fannie Mae is predicting that in quarter one 2027, rates will be around 6.4%, and quarter two, 6.3% onward. The MBA is steady at 6.7% through 2027 through 2028. But here's a major takeaway. Both forecasts agree on one thing. They don't expect a dramatic drop. They don't. We're talking about fractions of a percentage point, not a return of 3 or 4% rates that we saw back in COVID-19. So if you're waiting for mortgage rates to crash back down to these, forecasts suggest that they're probably not going to happen anytime soon. So what does this mean for you if you're thinking of buying, right? If rates only drift slightly lower than what we're seeing right now, what should you actually do? Straight from Matt Vernon, head of consumer lending at Bank of America. His advice is, instead of waiting around for a rate that you like better, hopeful buyers should look at their own financial situation, and if the house works for them and the payments are affordable, that might be the right moment to act rather than trying to perfectly time the market. And this lines up with the data. Affordability really comes down to two things: home prices and your own personal finances, your own financial picture, not just the headline of the mortgage rate. So if you're planning to buy, here are 3 practical things that you can do to get the best rate possible. Tip 1, watch rates closely. I know rates aren't going to change that much. Rates are shifting constantly, so staying on top of this trend and knowing the rates helps you just lock in a better rate window when you're buying. Tip number 2, check on your credit before you apply. Lenders use your credit to determine both your approval and your interest rate. Generally, the higher your score, the better your rate. You should pull your credit rate early to dispute any errors that you found, so when the mortgage lender pulls your rate, there's no discrepancies there. Tip number 3 is to shop around. This one is huge, and a lot of people skip it. According to Freddie Mac, buyers who have just 2 quotes instead of 1 saved over $1,500 over the life of their loan, and those who collected 5 quotes saved closer to $3,000 over the life of their loan. And that's huge, guys. That's huge. That's real money we're talking about here, from just making a few more phone calls and getting a few more quotes. And the good thing about that is when you get your credit pulled once, it doesn't hinder your credit when you get it pulled subsequently. Another tip: your actual rate also depends on the lender's own business costs and your own specific financial profile. So comparing multiple lenders isn't optional anymore. It's actually the way you find the best deal. So what this means if you're refinancing. Now, if you already own a home and you're wondering about refinancing, here's what you need to know. If mortgage rates hold roughly steady, like these forecasts suggest, I'm just a messenger, refinance rates should also follow a similar pattern. Keep in mind that refinance rates tend to run a bit higher than purchase rates, but historically the two move together. Whether refinancing your home makes sense for you depends on a few things: the rate you originally locked in to, how long you plan to stay in the home, and your overall reason for refinancing in the first place. A residential lending expert, Jen Bourque, I hope I'm saying that right, puts it so well. She says the key to evaluating your own actual reasoning, if your goal is consolidating debt, refinancing could make sense. But if you're purely trying to find a lower monthly payment, that's a tough goal to hit in today's higher rate environment. Her recommendation is to talk to a mortgage lender directly to explore your real options. Most experts agree that refinancing typically only makes financial sense if you can lower your current rate by at least a full percentage point. Since closing costs eat into your savings and otherwise costs, a few ways to improve your odds of a better refinance rate is to compare offers from at least 3 refinance lenders, ask directly about reducing closing costs, work on improving your credit score, consider a shorter loan term if possible, look into buying discount points, and just like with buying, most experts warn against trying to time the market perfectly. Waiting for a better rate next year is really just a gamble. It's not really a good strategy.
In the global market, we're seeing oil prices still increase. We're seeing the conflict in Iran that's really, really hitting that oil price, making inflation high. So that's why we're not really seeing rates go down. Another big factor is we're seeing the Fed has not lowered the rates at all in 2026. Last year, they lowered it 3 times, and that's why we had a little bit lower of a rate than last year. So I think we're going to stay steady at 6.75 for a little bit.
Rates in 2027 are expected to hold roughly steady, somewhere in a 6.3 to 6.5 range, depending on who you ask. That's not a dramatic drop from what we see right now, and it's not the drop that people are actually hoping for. So instead of putting your life on hold waiting for these rates to crash, focus on what you can actually control. Your credit score, shopping multiple lenders, and making sure that the numbers work for your situation right now. Because again, rent is 100% interest. So if this video helped you clear things up, drop a like, subscribe for more breakdowns like this. And if you know more in the comments, leave a comment below. If you're buying, refinancing, or just watching, hey, help someone kind of understand rates and what we can expect next year. Again, I'm not a mortgage lender. I'm not a professional in that sense at all. I am a realtor, and I am just, this is stuff that I found from the internet from my research, and I'm compiling it into a video. So thank you guys. Love you guys so much. Love you guys so much. See you guys soon. Bye.